shocking predictions for cryptocurrency going into 2022 and beyond. I'm going to explain this to you in 3 simple, fast steps. Step number 1, people are getting rich. When I'm talking about rich, some of these people are getting to be millionaires, even billionaires in cryptocurrency. But let's think through the numbers. The devil's in the details, as they always say. 14% of Americans now own cryptocurrency. Their combined net worth has gone up almost $2 trillion since the beginning of 2022. I've got a chart right here going all the way back to March 2020, the beginning of the cerveza sickness, all the way to today, September 2021. On the left, we start at $0 trillion. We go up to $2 trillion. The market cap for cryptocurrency, that's what this chart is illustrating, starts off at $144 billion. This was not 10 years ago. This was basically 1 year ago, or a little over a year ago, at the beginning of the cerveza sickness. It goes pretty straight for a cryptocurrency chart. And then before January, it goes completely parabolic and peaks out over $2 trillion. And then it comes crashing down, but it's rebounded to a point where it's still right around $2 trillion. So if we take the $2 trillion, we subtract where it came from at 144, that's why I'm saying the net worth, or the increase in net worth for these 14% of individuals who own cryptocurrency has gone up by almost $2 trillion, a staggering amount. But to understand what may happen to the price of cryptocurrency and cryptocurrencies themselves moving into the future, we have to understand who owns crypto today, the demographics, and why those individuals own so much crypto. Why have they moved over into that space? What has prompted them to make those decisions? First of all, the demographics. The main group that owns cryptocurrencies, male, ages 25 to 34. They're making, on average, about $25,000 to $35,000. Editor, go ahead and throw out the chart. We can see this is 25 to 35,000 pounds. This study was done in the UK, so in dollar terms, might be a little bit more, but you get the general idea. We know one thing is for sure. In the trailing 12 months, they absolutely crushed it. They knocked the cover off the ball. A lot of these cryptocurrencies are up 2, 3, 4, 5, 10, 100 times. Who knows? But at the end of the day, demographics are just numbers and statistics. I think it's far better to get your mind around who actually owns cryptocurrency through a visual representation. So I summoned all of my artistic ability and created this guy right here. His name is Crypto Caleb. Let me describe all of Crypto Caleb's characteristics. First of all, of course, he's kind of a hipster guy. He's got his really clean haircut with the part right on the side. And of course, he has a beard because Caleb has so little testosterone that he's got to overcompensate for it by having that facial hair. And he has tattoos showing what a badass he is. He's got his El Salvador shirt on. And of course, he's holding a sign that says, "Follow me on Insta," while he's holding his soy cafe latte that he just got at Starbucks. He has a dog because every male in that age group has to have a dog and take it with them everywhere, regardless of whether they're going to a restaurant, in an airplane, or how wildly inappropriate it may be. He's wearing these pants that kind of aren't pants. They're more like a modern day version of knickers. I have no idea why men actually choose to wear these pants. It would be sort of like a a prison sentence for me. If I did something wrong, it would be my punishment. And all of them have these badass off-road vans, or always Mercedes. I think it's some sort of transit van. They've got the ladder on the back and these racks where you can put all your luggage. It's a proper Bear Grylls type of off-road adventure vehicle. They like to think that they can bug out at any time, but the only thing they're really doing is kind of bugging out of their parents' basement. So now we know what the average crypto investor looks like. Let's dive into the psychology. What has prompted them? What has driven them to make these decisions? Well, it starts off, like it usually does, with the Fed and your drunk, insolvent Uncle Sam. They have been sending Crypto Caleb stimmy checks for the last year. His income has skyrocketed from all the free money that he is getting from the government. But more importantly, the Fed has kept real rates negative for a long time. Now, I know that if you buy into the CPI, there's been several times throughout the past few decades where real interest rates have been positive. But if you actually look at how much prices have gone up, I think everyone would come to the same conclusion that real rates of interest are usually negative. That means that you're losing purchasing power by holding cash or by holding a bond that is only paying you, let's say, 2 or 3%. It's really important that you, everyone watching this video right now, understands how that impacts society as a whole. We might not consciously always think about it, but subconsciously, we know that if we keep our money in the bank or in bonds, we're going to lose purchasing power over the long run. So what this does is it pushes us, the average investor, the average Joe and Jane, and Crypto Caleb, further and further out the risk curve. They've got to take more and more risk to make sure that their savings is not only keeping up with inflation, but hopefully accelerating at a faster pace. But it's not just stimmies and negative real rates pushing people further out the risk curve. It's also that there's fewer opportunities out there for those young people who are graduating college, or those middle-aged millennials, we'll call them. The government has created all of these economic distortions. They've created malinvestment and a misallocation of resources, which has incentivized businesses to speculate on financial assets instead of reinvesting back into their business, growing their business, trying to produce more goods and services by hiring more people and creating jobs. Because of the actions of the Fed and the government, our entire economy has been financialized. And what that means for Crypto Caleb is fewer good job opportunities. And the central planners have also disincentivized Caleb to become an entrepreneur himself because of all the additional regulations and most likely taxes going to the moon in the future. We hear the administration and the mainstream media all the time talking about how bad and evil the capitalists and the entrepreneurs, the producers and job creators are in our society. And we really need to bring them down a few notches for the greater good. So why on earth would Caleb want to sign up for that? It's far easier to take your stimmy checks and just put them on Dogecoin, because at the end of the day, it is YOLO time. You only live once. But this meme is just a representation that illustrates how much the Fed has pushed the average investor out the risk curve. If I had a picture of Jerome Powell right here, he would be holding a sign saying, "Take more risk." To explore this YOLO attitude that has been driven by the Fed and the government creating negative real rates and inflation, let's cut to the internet and a comedian named Remy. You guys are really going to get a kick out of this one.
Coming up, bad news for savers, as even those with high-interest savings accounts are seeing their money disappear thanks to inflation. But first, we'll detail every possible thing you could die from. He's a rational investor, dividend digester, saves some of his paycheck just like all his ancestors. Him looking for high yields, that's never the case. He's seeking 6% returns. Slow and steady wins the race. But when he checks his accounts just to see what they're fielding, it's like driving in Maryland. Ain't nobody yielding. What is he to do? He shouldn't be in a drought. So he visits his advisor just to sort it all out. Inflation's higher than your bond rate. That's what I was fearing. So your savings account is slowly disappearing and your CDs are pointless. That's not very funny. What would you like me to do? Put it all in dog money. Dog money, dog money, dog money, dog money. I'm trading it in for dog money, dog money, dog money, dog money, dog money. I'm putting it all in dog money. My 401k is now a 401k9. The sum of my net worth ain't no longer in a straight line. I'm making smart moves. I ain't gonna be a pun. I sold my IRA and bought an NFT of one. All in on Doge, I dish them out like a Tommy gun. You think I was statehood the way I'm passing on Washington? I feel like Matt Gates, you know what I mean? Assuring everybody it's above 18. It's a modern day gold rush. The prices will boom like Reggie White versus the Oilers. I'm headed straight to the moon. My broker's calling, you know that it's on. Buy dog money, don't stop till it's dawn.
Step number 2. Now I'm going to reveal my first prediction. Are you ready for it? Your 401k is going to turn into a 401k 9. Sorry about that. After that last video, I could not resist that little joke. Okay, let's start with these charts. First of all, the unemployment rate goes back to 2008 all the way to 2021. Starts around 4% and then skyrockets up to about 12% during the GFC, then gradually comes back down to an all-time low, or very close to an all-time low, 2020 before the cerveza sickness, under 4%. But then it goes completely parabolic up to 15 or 16%. And keep in mind, this is the U3 unemployment number. That's the headline number you always see on CNBC and Bloomberg, which I think understates the real rate of employment dramatically. We'll save that for another video. So the way the Fed and the government measures U3, it has come back down. In July, it was 5.4%. But notice, there's quite a delta between the 5.4% we have now and the under 4% we had prior to the cerveza sickness. So the Fed is looking at this, and they have this mandate for unemployment. So they want to get this number back down to under 4%. And then there's also politicians like AOC, Elizabeth Warren, Bernie Sanders, that think Jerome Powell is nowhere near dovish enough. Oh yes, that's right. That $120 billion of the QE isn't near enough for those politicians who want more and more central planning. They want to see the Fed bring the unemployment rate down to maybe 1% or 0.5%, regardless of the rate of inflation. But I'm sure most of you by now have heard Jerome Powell always come out and say that inflation is transitory. In fact, in that presentation that they gave to Congress the other day with Janet Yellen, or whatever they want to call it, I can't stand to pay any attention to those things. But in their testimony, we'll call it, both he and Yellen said that yes, inflation is transitory. And their argument really revolves around something called the Phillips curve. So we start here on the bottom, 3%, 4% goes all the way to 7%. This is the unemployment rate. Over here, the vertical line starts at 2%, goes up to 7%. This is the rate of inflation. So basically, what the Phillips curve says is that as the rate of unemployment gets higher, the rate of inflation gets lower. So there's an inverse correlation between the unemployment rate and inflation. Said another way, if unemployment goes down, then inflation will go up. So the Fed is looking at the unemployment rate being higher, much higher than it was at the end of 2019. And they're looking at the Phillips curve and saying, well, there's no way that we have sustained inflation because the rate of unemployment isn't low enough. And for most of you who are really paying attention right now, you're probably scratching your head and saying, wait a minute, George, wasn't the Phillips curve really debunked in the 1970s? And I would argue that it was debunked pretty much in every single decade. But believe it or not, the 900 PhDs at the Fed still use the Phillips curve to make decisions and to predict whether or not inflation is transitory or permanent. But then the next question becomes, okay, we know the Phillips curve is broken, but has cryptocurrency broken the Phillips curve even more? And this is a fascinating thought experiment. To dive into this deeper, let's go right to the internet and a blog post from one of my good buddies who actually used to work at the Fed. His name is Joseph Wang. All right, so Joseph's blog is called Fed Guy. It's at fedguy.com. I'd strongly suggest checking it out. Every one of his blog posts are awesome and thought-provoking and extremely interesting, to say the least. So let's start by going over his most recent blog post, Wealth Side Effects. And this is where he is arguing that because the stock market and cryptocurrency has gone up to such a significant degree since the beginning of 2020, that it is having an impact on the labor force participation rate and therefore the unemployment rate. So a lot of people are choosing to not go back to work because they've increased their wealth so much by, we'll call it quote unquote, investing or speculating in cryptocurrency and the stock market. Why on earth should they go back to work and make $15 an hour when they just made $30,000 in the last 2 months in Dogecoin, as an example? He starts by pointing out this chart of the estimated increase in median wealth from 2019 to Q2 2021. And it is true that the people at the top of the economic ladder really saw most of the gains. Their net worth increased by an average of $553,000. Wow, that is really incredible. But then he also points out the surge in asset prices has been so extreme that even less wealthy cohorts saw meaningful gains since 2019. And we can just go back to the chart and see people even in the 25 to 50 percentile, their net worth increased by $18,000. That is a significant amount, assuming you're making, let's say, $30,000 or $40,000 a year. So Joseph's hypothesis, which I would completely agree with, is because we've seen such extreme wealth gains, this has dropped the labor force participation rate significantly because people are just choosing not to go back to work. And what's odd is we have this dynamic in the labor market where job openings are at all-time highs. So the Fed is sitting back kind of scratching their head. None of this makes sense to them because if job openings are at all-time highs, that would indicate that the labor market is very tight and therefore the unemployment rate should be a lot lower than the 5.4% that we saw on the chart going back to the whiteboard. Now let's go ahead and start connecting some dots with cryptocurrencies. So this section of the blog post is called Dark Money. Cryptocurrencies are a $2 trillion asset class absent from flow of funds data because they exist on decentralized ledgers outside of national reporting systems. Crypto as an asset class was negligible in 2019, but may have grown to levels that are impactful on a macroeconomic level. Like dark matter, it is exerting influence without being seen. Now we go over some more statistics that really put things into perspective. It's called fast money. The scale and speed of the rise in household wealth is simply unprecedented. The roughly 40 trillion increase in household wealth over the past 2 years is real money that can be spent on goods and services. And he points out here correctly, just not all at once. Don't sell all at once or the price will come crashing down. This has obvious implications for consumption and inflation, but also on the public's urgency to seek employment, what we were talking about earlier. Stopping the flow of unemployment payments may be less impactful. And I think that definitely has a lot to do with it as well. But I've done several videos on that. So we'll stick to the topic of this wealth creation, cryptocurrency, and demotivating people to go back to work. So stopping the flow of unemployment payments may be less impactful in encouraging employment when the stock of wealth has grown tremendously. And this chart is really jaw-dropping. It's households and nonprofit organizations' net worth level. So we can see it dip down, which is what you would expect in the GFC. And since then, it's gone straight up into the right. But look at what happened after the cerveza sickness. It not only goes up into the right, it goes pretty much straight up. It's a Buzz Lightyear chart to infinity and beyond.
To infinity and beyond.
Just to reiterate, over the last 2 years, household wealth has gone up by approximately $40 trillion. The Fed appears confused by the labor market. There are many signals of the labor shortage, even though the unemployment rate is also elevated. The Fed is holding rates low on the belief that the economy is far from maximum employment, even though inflation is high. This goes back to the Phillips curve that we were talking about. But if the wealth effect has structurally changed the labor market, then the Fed is viewing the world through an outdated model. So let's think about this for a moment. What happens is people still have the same amount of purchasing power, or more purchasing power for that matter, but yet they're not going back to work producing goods and services. And in the mind of the Fed, if people are unemployed, then they should see a decrease in demand. And that ties into the inflation rate. So if demand goes up, even though the unemployment rate stays persistently high, the Fed is going to see that and assume that inflation is transitory, because they're going to assume that they actually have less purchasing power because they're not taking into consideration this wealth effect that Joseph Wang is pointing out extremely well. So therefore, it may take much higher wages to reach the pre-pandemic unemployment rate. The Fed may be inadvertently running the economy much hotter than they realize. So in order to get people to go back to work when they're making $30,000 every 2 months trading cryptocurrency, wages are going to have to go from $15 an hour, let's say, up to $30 or $50 or $75 an hour. And then that will exacerbate the problem of inflation that the Fed thinks doesn't exist. So my first prediction is the Fed is going to continue to use the Phillips curve to make policy decisions moving forward. And because cryptocurrency has created so much wealth, at least paper wealth, on the balance sheet of those 14% of Americans who have less of an incentive to go back to work, the unemployment rate, as measured by the government and the Fed, is going to be persistently high. Therefore, the Fed is always going to come back to the conclusion that inflation is transitory, regardless of how many years it goes up at 6%, 8%, 10%, 12%. Who knows how high it will go? And we've seen this movie before. It's not the first time the Fed has inaccurately come to this conclusion. I'd like to take you back to the early 1970s. At the time, the Fed chair was a gentleman by the name of Arthur Burns. And just like Jerome Powell, he was coming out and making the claim that inflation is transitory. But we all know what happened throughout the rest of the 1970s. Arthur Burns was proven wrong over and over and over again. And I think Jerome Powell will also be proven wrong in this decade. And I know a lot of you right now are saying, okay, George, I understand the stuff with Arthur Burns and the inflation being transitory or permanent, but that's not really a specific prediction about cryptocurrency or the price of cryptocurrency. But don't you worry, my friend. We are going to connect all the dots in step number 3, coming up right now. Step number 3. Now it's time to reveal my big cryptocurrency predictions. But before I do, I can give you a prediction that is 100% guaranteed to come true. And that is Mr. Joseph Wang will be speaking at the next Rebel Capitalist Live event in Houston. If you haven't checked out Rebel Capitalist Live, definitely do so as soon as this video is done. We'll put a link in the description below, but it's just rebelcapitalistlive.com. You can see all the speakers that will be in Houston January 7th through the 9th. Guys like Ron Paul, Chris Cole, G. Edward Griffin, gals like Lynn Alden, Lynette Zhang, and like I said, Mr. Joseph Wang, the Fed guy himself. But back to the cryptocurrency predictions. In step number 1, we saw that Crypto Caleb has gotten rich to the tune of $2 trillion just in the last year. Then in step number 2, we saw that all of these gains have most likely decreased his willingness to go back to work. Therefore, the unemployment rate stays higher than it otherwise would, and the Fed thinks that inflation is transitory. So they continue to put the pedal on the metal. Don't worry about inflation. This means that it most likely will run hot into the future. And let me be very clear, when I'm talking about inflation, I'm specifically referring to the stuff, the goods and services you buy daily. So I set up this chart just to get a visual of the main concepts I'm trying to communicate. First, on the left, it goes from 0% up to 16%. This is the rate of increase. So right in the middle, this red line, let's just assume this is the rate of inflation going into the future. And I'm not saying this is a prediction in and of itself. We're just using this as a thought experiment. So inflation going from 8% up to 10%, 12%, 15%. Well, stocks and real estate, let's say they are also going up in nominal terms, but they're only going up at maybe 4, 5, 6, 7% per year, which for most Americans, the average Joe and Jane, they look at that and they think they're getting rich, but then they start to do the math and they're like, wait a minute here. Yes, my house is going up at 5 or 6% per year, but my grocery bill is going up by 30% per year. So they realize, it dawns on them that the stocks and real estate are going up at a lower rate or less than inflation. But then they look at cryptocurrency and they see that it is going up at a rate that vastly exceeds inflation. So they come to the conclusion logically that the only way they can stay ahead of the inflation curve, because remember, we've got the Fed and your drunk insolvent Uncle Sam that is pushing the average Joe to take more and more risk because of these negative real rates. So the average Joe says to himself, well, I've only got one choice if I want to actually increase my purchasing power, or at least just stay up with the rate of inflation. I've got to move all of this capital from stocks and real estate into cryptocurrency. And for those of you who are cryptocurrency fans, you may be saying, well, that's fantastic news, because that means the price is going to go to the moon. But unfortunately, there is a big problem. To dive into this deeper, let's go right to the internet and check out this study from the BIS, the Bank of International Settlements. This is a report titled Early Warning Indicators, what they call EWIs, of banking crises. Let's scroll down here and we can get to some of their charts. Evolution of EWI, that's early warning indicator, variables around past banking crises. These charts are a little difficult to decipher, so let me walk you through them. This 0 indicates when there was a banking crisis, and this black vertical line, and it shows different metrics they used to try to predict when this banking crisis would come to fruition, and not only predict when, but also the probabilities of it actually panning out. So the first metric they use is credit to GDP. So the overall credit in the economy, the public and private debt relative to the country's GDP. Let's just use the middle red solid line because that's the median. So what this is saying is it's going up at 8% above the trend line, the historic trend line. It's not saying that it's going up at 8% nominally. That's just 8% above the trend. So if the trend, let's say, was 2% and now it goes up to 8%, then the delta would be 6%. And that's what this solid red line would indicate. Another thing interesting about this credit to GDP is that when it gets to a peak, that's usually when you see the banking crisis. So it happens kind of in real time. Contrast that to the data represented in this property price gap, and we're going to focus on that solid red line again. And this represents the same thing. It's just the delta between the historic trend line and the current rate of price appreciation, or the gap between the prices and the income level. So the price to income ratio difference between what they've experienced, let's say over the past 20 quarters, and the historic trend. That's the important metric. But you can see here, it peaks out usually about 8 quarters prior to an actual banking crisis. So this would be more of a leading indicator. And they also have metrics like DSR, which is debt service ratio. I'm not going to get too into the weeds on those other metrics because I want to focus on credit to GDP and also property price gap. What this BIS study shows us is these are the most predictive indicators when you're trying to assess the probabilities of a banking crisis. So I'd imagine a lot of you are asking the question right now, okay, George, if a country gets over its skis, so to speak, or they breach this level, which would indicate the no bueno zone. The BIS might not use that terminology, but they'd call it probably the danger zone. What is the probability that this country has a banking crisis? And from what I've read in this report, the probability can be as high as 50%, depending on what metrics that country actually triggers. But the metrics we just went over are so powerful that they usually supersede the rest. So as an example, if the property price gap or price to income ratio in a specific country gets too extreme, even if that country hasn't triggered any of the other red flags, it could still make the probability of a banking crisis go up to that 50% number. And what I would argue is in a country that has been so financialized, like the United States, not only could a property bubble imploding create a banking crisis, but I think you could see the exact same thing happen if the stock market were to go down by 50%. Just sit back and ask yourself the question, what would the economy look like if the stock market went down by 50% and stayed down by 50% for the next decade? Something similar to what we saw in Japan in the 1990s. I think most of you would come to the conclusion, and rightfully so, that that would create an economic crisis in the United States to the likes which we may have never seen. It may even exceed what we saw during the Great Depression. So let's think this through using the example of these hot air balloons that I think gives us a great visual representation of the overall concept. So we've all seen it on a Sunday morning. Those hot air balloons are going up over the sky and the clouds, blue sky. It's a really cool thing. And there are all these bright colors. And at the bottom of those hot air balloons, you see this little woven basket. And that's where the people are kind of hanging out there and floating around. In the past, when we have a proper, fundamentally sound economy, I see it as though it's this hot air balloon that's controlling or leading this basket that is following it around. So in a healthy economy that really revolves around producing goods and services, true wealth, the real economy would be that hot air balloon. And the financial economy, like the stock market or the housing market, would be the basket underneath that hot air balloon. So wherever the balloon goes, in other words, wherever the real economy goes, however well it does, the basket will do the same, the stock market and the housing market. But what has happened as a result of everything that we talked about in step number 1 is we've completely reversed the roles. So now we go into this completely distorted type of economy that's been totally financialized. So the balloon has gone from the real economy to the financial economy. And it's the one that has power or control of the direction of everything else. And now the basket is the real economy. So wherever the financial economy goes, so goes the real economy. And that's why the Fed has had to come in so many times and bail out the banking system and the banksters themselves, because they know that if the financial economy collapses, the stock market or the real estate market, the real economy will collapse as well. But here's where it gets interesting. If we see this dynamic play out in the future, because the Fed has to let inflation run so hot before they reduce the size of their balance sheet or they increase interest rates, we see the capital flows going from stocks in real estate that have a negative appreciation rate or a negative yield compared to the rate of inflation. We see the capital flows go from stocks and real estate into cryptocurrency. Then, because we financialized the economy so much, we could transition into a brand new type of hot air balloon where the price of cryptocurrency is the actual balloon, and now the real economy is tied to the price of Dogecoin. And let's go back to that thought experiment we did during the reading. If the stock market goes down by 50%, remember, most of you would agree that that would collapse the entire real economy. Same thing for the housing market. But now, if all of the capital and the assets on the balance sheets of Americans is tied up in cryptocurrency, the same thing would be true. That if the price of cryptocurrency goes down by 50, 60, 70%, then this in and of itself would collapse the real economy, regardless of what was happening to the stock market. and the real estate market. And to make this even more bizarre, if the economy started to go down as a result of the price of crypto collapsing, then the Fed would have to come in and save the day because they have these mandates such as the unemployment rate. Well, if the unemployment rate in the real economy, let's say, goes up to 15% because crypto falls out of bed and goes down by 50%, then the Fed would be left with a decision. They would have to come in and literally prop up the price of crypto, just like they have done quantitative easing to prop up the price of the stock market and the housing market. But step back for a moment and think about this paradox. Let's take out the word crypto and just replace it with the word Bitcoin. Of all the cryptocurrencies, this one has the highest probability of competing and maybe taking down the US dollar. So the Fed would be put into a position where they have to prop up the actual competitor to the currency that gives them power in the first place. So what are my big crypto predictions moving into 2022 and beyond? Well, the Fed is definitely going to continue to push people out the risk curve by maintaining a negative real interest rate. And I think the negative real rates we see now could actually increase moving forward. And this will incentivize people to take money out of the stock market and real estate and move it into cryptocurrency. So as long as we see this dynamic at play, there are no certainties, only probabilities. But I think there's a significant probability that the market cap for cryptocurrency continues to grow. Now, which ones go up and down? I have no idea. I'll let you draw your own conclusions. And I want to be very clear. I'm not saying that this is a reason to speculate in cryptocurrencies. I would never ever buy something just because I thought the price was going up. That's just pure gambling. What I'm doing is going through a thought experiment so you can better understand the risks we have to the real economy. And one more thing I'd like to point out, this dynamic that we're talking about with cryptocurrency taking all the inflows could continue into the future as long as there's not another asset class that comes up right alongside it where the gains are even more than what we've seen in cryptocurrency. Can anyone say NFTs? For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.